Masterclass Building a Strong AIF Distribution Business. Building a robust distribution business for alternative investments demands a strategic and comprehensive approach. It begins with cultivating a deep understanding of the target investor base and tailoring distribution channels accordingly. Effective communication and education are paramount, requiring transparent and articulate messaging about the unique value propositions of alternative investments. Technology to streamline communication, facilitate investor interactions, and provide real time reporting enhances efficiency and builds trust. Establishing strong relationship with financial advisors and institutions, coupled with robust due practices. It critically for gaining credibility in the market. Regulatory compliance and adherence to industry standards contribute to building a trustworthy brand. Continuous market research and adaptation to evolving investor preferences ensure that distribution business remaining agile and responsive to changing dynamics with the alternative investment landscape. Overall, success in this endeavor hinges on a combination of expertise, integrity, and a dynamic approach to the distribution ecosystem. To take us through this, to how to build a robust AIF distribution business, we have with us Bhautik Ambani, CEO, Alphagrep Investor Management.
Thank you. I know I'm the last session, I'm the one holding you back from going back home, so I'll try and keep this as short and sweet as possible. I'm also very happy to see that, my guru, who's actually from whom I've learned a lot of where I am today, is sitting in this audience today. So Manish, I can't have a better forum to thank you. Right. So, thanks. Let me just give you a quick background about myself, about people who don't know me. So I have spent the last 19 years in the asset stroke wealth management space. First half of my career was with mutual funds, and the second half of the career was in the alternate space. So pretty much the last 10 years has been on the alternate side, primarily Cat 3, primarily long short. And 10 years would basically mean that from the time long shorts got launched in India, since that time, I have been meeting clients, distributors, and doing a lot of education around this space. I know they've called the session Masterclass. I don't think I'm any master at anything out here. The only thing I'm going to talk about today is, and that's the reason I have just one slide, is very, very simply put, what I have done in the last, let's say, 18, 19 years in terms of raising assets or building a business, wherever I've worked, right? Just to give you some sense of what we managed to do, let's say in the alternate space in the last 10 years, at Ambit, when I started the journey on long short, at peak, we used to manage around 1,200 crores of assets. Then we as a team moved to Avendus Capital. Again, out there, journey was pretty good. At one point of time, we used to manage almost $1 billion across a couple of long short funds. And I moved to Alphagrep a year back. It is a 13-year-old firm, but has just gotten into asset management 3 years back. And once I joined them, there was already one Cat 3 fund, which was on the platform, started raising capital for that fund from April last year. And we managed to raise close to 1,000 crores in the first 6 months on that fund. And very recently, we've launched another Category 3 AIF and hoping to raise a similar number in the near future, right? And from a longer-term perspective, hoping to build a much larger asset management platform at Alphagrep. If we just go to the next slide. So this is all I'm going to talk about today. And to my mind, this is what has been relevant for me from a fundraising perspective, whichever way I look at it, whether it was mutual funds or alternates, right? So before I get into any of these points, I think the most important thing which matters out here is that a lot of us try to complicate the fundraising efforts, think a lot about it. But to my mind, keeping things simple helps. And that is what has always at least helped me, right? So before anything else, on the Cat 3 alternate side, I think as a platform, what SEBI has offered us is the only platform which can actually allow us to do something different. Because pretty much what you can do on mutual funds, PMS, is more like traditional investments, which most of the players are doing. Very difficult to differentiate other than performance. Cat 3 long short or Cat 3 as a platform does allow you to do multiple things, right? So that's a big advantage of Cat 3 as a category. Having said that, because the entry barrier is not as high as, let's say, a mutual fund, there are many people or many players who obviously have entered this space. So that's the reason you have a couple of hundred players having a Cat 3 license doing differentiated products, which means there are a lot of people talking about differentiated products to distributors, to clients, to family offices, right? Which means that one has to differentiate themselves to get that mind space, right? And that's the reason, before one actually even thinks about launching a product or doing something, I think the most important thing out here is to think whether the product itself can differentiate with, the number of products that are there available in the market, right? Because if you think about it today, when I go and meet, let's say, a family office and a professional who is sitting there, maybe it's a 1, 2, or a 3-member team, they are bombarded with maybe 20 or 30 wealth managers talking to them, and they're bombarded with almost 40, 50 asset managers trying to talk to them, right? So imagine that 1 or 2-member or 3-member team trying to skim through so many products, right? And trying to evaluate and gauge, which is the right one. So we may think a lot of times that, going to some of these places, we should just get the mind share, mind space, and get an investment, but it's not that easy because you have to always try and put yourself in their shoes and think about it that how relevant are you when you're going and talking to them, right? So that's another very important thing. Just beyond product, I think the next most important thing is knowing the market, right? And that's where I think a lot of people tend to make a mistake and try to compare, let's say, to the Western market. So if you think about it, the Western world, right, the developed markets, the investments that go into the public markets primarily come through institutional investments, right? Which means that out there, you're talking to a handful of institutional investors that you can go and meet, target, talk to, and they will cut the big checks, right? Versus when you talk about an Indian market, especially for Cat 3, it's a completely polarized market. You don't have institutions investing in the Cat 3 world, right? Which means that you have to target individual investors, right? We may call them HNIs, we may call them family offices, right? But ultimately, compared to the Western world, it is an individual market, it's a retail market, right? We don't have an institutional market for Cat 3 per se, right? You don't have the endowments, you don't have the foundations, you don't have the insurance companies being able to invest in Cat 3 funds, which means that you don't have a choice but to go to thousands of people, right? Now, that's a common debate that I've had in previous organizations, and it's a common debate that I continuously have all the time, is that should we be going more direct or distribution? But think about this. If you want to go direct, and again, there is no right or wrong approach out here. The only thing that one needs to understand is that there are pros and cons of every approach that you try to take out here. So let me give a very simple example. Let's say if somebody says that I want to only go direct because I don't want to pay a large sum of my fees to distributors, right? And we all know that, there's a large sharing of the fees that we make, which goes to distribution partners, right? Let's say somebody wants to take that approach, but then you have to be ready with the fact that A, how are you going to target those thousands of investors out there? Why will that HNI talk to you when he has 5 other wealth managers where he has relationship for the last decade? How are you going to approach them? How are you going to talk to them, right? So it's very easy to say that I want to go direct. What one has to understand is that there are so many places where, even in the past, even today, where we may have relationships with some of these family offices, investors. But just by having a relationship doesn't mean that they are going to invest with me. A lot of times, that same relationship where, I may know the person for maybe 5 years, right? But when a wealth manager takes me along, he is listening to me in a very different way because there is that added weightage that a wealth manager is bringing to the table, right? We may give advantage, we may give some importance to that, we may not give, but there is a weightage that they do bring to the table. Because that investor knows that this wealth manager has done some amount of due diligence, his product team has done some due diligence, that RM is somebody he trusts because he's dealing with that person for a very long period of time, right? And that's a common debate that a lot of people have, that I don't want to pay this 50%, but the point is that one has to understand the fact that if you don't want to pay this, you have to have a very, very long journey of creating that brand, creating that performance, consistency of performance, and then waiting it out. Right? So if you don't have the patience, then one has to think about it, that what's the roadmap that one needs to take or wants to take out here, right? Second thing is that I think, the way I think about the whole, when I think about pricing and everything, right? I think it's a simple triangle out here. There are only three people that matter, right? It's the investor, it's the distributor, and it's us as an asset manager, right? And everything that you can make out of this pool, right, comes out of that gross return. It's as simple as that. So everything that comes out of that gross return, and obviously there's one more partner, which is government from a tax perspective, but that's a fixed sharing, right? And it's only on the upside. There is nothing on the downside, right? But everybody else that one has to think about is from that one finite pool. So in that triangle, if all the three are not going to be taken care of, you can't have that triangle meet ends. It's as simple as that, right? And that's the reason, a lot of times, again, people start thinking that, what if I give, let's say, the distributor more? Then you're going to cut it out of the investor. If you give the investor more, then either you take less or the distributor takes less, right? Again, from a distributor perspective, it's very simple, that when we try to price our products, we think about it that, what are the alternatives for a product that we have? Let's say, for example, when we, or not even here, even previously, when we used to raise capital for our absolute return fund, we knew for a matter of fact that this is a debt replacement. Now, if it is a debt replacement product, I have to try and understand that what are the other alternatives for the wealth manager in the debt space, and what are his or her revenues in that space. Am I going to get him a revenue stream which is going to be better than that? Yes or a no? If the revenue stream is not going to be better, I know for a matter of fact that he has to put in additional effort to sell a long short fund to a client versus, let's say, selling a traditional debt product. And for that additional effort, anyone is going to ask for an additional compensation. It's as simple as that, right? The second thing that one needs to understand is that, is that partner going to be okay with a variable compensation versus a fixed compensation? How consistent can that compensation can be for the distributor, right? Because that also matters. Because for a lot of other traditional products, he knows that my income stream is going to be fixed, it's going to be fairly consistent. So these are some of the smaller nuances that one needs to think of when they are trying to take their product to the market, right? You will do a similar exercise, let's say if you're positioning your product in the long only space or a long bias, long short space, because then you're competing with equity. Now one has to understand that in a debt replacement, if you are that distributor is making X, for an equity strategy, he is expecting X plus. He's not going to be okay with X, right? Second thing is within distribution, again, I think the first port of call for most managers is the larger wealth managers, right? That's where we all go. What one needs to understand again out here is that, yes, there are the larger wealth managers who obviously control a larger pie of the market. But having said that, larger the wealth manager, right? More number of people are talking to them. Now, if there are going to be more number of people approaching them, talking to them, right? Ultimately, they have only that much of space that they can allocate or talk to, right? And the other thing is that bigger the brand, right? I'm not saying it doesn't matter to others, but sometimes for larger brands, what also matters is that they will not take that much more risk by taking a smaller boutique wealth manager or boutique asset manager to their clients. Because ultimately, beyond the point, it is a risk, right? What if you don't perform? What if something goes wrong? Because a lot of times, a lot of the strategies that we run especially the complicated strategies, whether it's long short, whether it's crypto, whether it's something else in the Cat 3 space, it's very difficult for a lot of these wealth managers, or their teams to even understand or evaluate these products beyond a point. So if they can't understand it, can't evaluate it, right, they are going to rely on who's bringing that product to them. What is the kind of track record are they bringing it to the table? And how much do I trust that track record? And not only that, how much do I trust that they will not make any big mistake going forward? Right? Because what they are scared of is any kind of mistake. Because if there is any blow up, ultimately the client is going to catch hold of them before they come and catch hold of you as an asset manager, right? So again, that's something which is very important to my mind. The other thing is that, it's just not about taking money from clients. It's also about the support that you give, right? And not just support to the clients, but also support to the distributors, right? Because what they don't want is to deal with somebody where they have issues. Because beyond a point, a lot of these guys want something which is a smooth process, right? Any challenges, any issues, I've seen it multiple times. Even if one transaction goes wrong, and we just spoke about, we had a session on technology, right? And a lot of transactions are now happening digitally. I've seen it multiple number of times where, a client is trying to do a digital transaction, something gets stuck somewhere, right? And when you promise, let's say that transaction will happen in 15 minutes, if it takes 1.5 hours, we know that that same RM will not do the next transaction digitally. Is that one experience which will change the entire dynamics for at least that one RM, right? So the next 5 clients are not going to come digitally for sure. So that's the reason it's very, very important that when you're offering, it's just not about the product that you're offering or just onboarding options. It's also about how you offer them, what kind of support do you offer them, how well do you handhold them, right? So that's also very, very critical out here. And not just when you're onboarding, but even after that. Because they will need constant support. And that constant support is very, very important, right? And it could be around tax, it could be around, calculations, it could be around, talking to their tax advisors, because ultimately we are running strategies which are fairly complicated from a tax perspective as well. I just wish we had a product which was as simple as a mutual fund, right? But unfortunately we don't. But theek hai, matlab, that gainfully employs some of us, right? Which is good. The other thing which I think, again, is very important is that, and again, I see that with a lot of asset managers, some friends that I talk to about and who are also in the similar space, is a lot of times people just see that, that other asset manager launched a fund and raised 500 crores in such a short period of time. Why am I not able to do that? My performance is similar. I don't think it's one size fits all. I think it's a very, very simple thing that thankfully in the Cat 3 space, I think for most asset managers, we're not looking at raising like, tens of thousands of crores, right? Because most strategies actually don't even have the capacity to manage that kind of capital. If that is the case, then you're not in the market share game like one is in the mutual fund industry, right? In the mutual fund industry, when I used to be there, we used to talk about market share. Mumbai ke andar iska distributor ka itna market hai, uske andar how much are you, right? But that's not the case here because the ocean is so large, right? That you need a very, very small chunk of money from that. Which means that if you do the right thing and you do that on a consistent basis over a period of time, you will get the assets. It's only about having the patience to do the same thing on a continuous basis over a period of time. It's only a matter of timing. To give you an example, when we launched, or when we had a fund at Ambit, I remember when I joined, it was around 40-50 crores in size. From 40-50 crores to almost 200 crores took us a year. From 100 crores, 100 crores to almost 300 crores, it took us another year. And in the third year, we got from 300 crores to around 1,000 crores, right? So it took us 3 years to get to 1,000 crores. We moved out of Ambit, we moved to Avendis, launched exactly the same strategy, same team, everything same. Launched the fund, I remember in March. And within 8 months, we were at 3,500 crores. Did I do anything differently there? No. Or did any one of us do anything differently there? Answer is no. Right? A lot of times it is also about where you are in the market, the timing, and there is a luck factor to it. It's just certain other market forces which will just come together, and that's the reason that you will benefit. So one has to be patient. Because as long as you're patient, you will get the assets. The second important thing out here is that, and which is something that at least whenever I talk to the investment team and I focus a lot on, is risk, that avoid the big mistakes. Because as long as you are doing something on a consistent basis and avoiding the big mistakes in terms of returns, in terms of losing big money at any given point of time, I think most of the times you'll be fine. Because the problem is that if you have one big mistake, to recover from that takes very, very, very long. Because as soon as you have a mistake, you lose trust from a lot of investors, a lot of partners, and to regain that trust is a much longer exercise, right? Which we've seen multiple times in front of our own eyes with a lot of players, right? And that's the reason, at least from my perspective, I do focus on that a lot, right? That at least ensure that it's fine that you may have a year or two where your performance is, let's say, below or it's second quartile or third quartile compared to some of the partners or some of the competitors, right? Or maybe you are slightly lower than what your promise was, because markets every year are not going to be the same, right? And nobody can be number one always. So if that's not the case, then it's fine that if you're, and I'm telling you, be rest assured that 90% of the investors are fine with slightly lower returns than what you've told them. You will still always have that 5-10% people, even if you're the best, they will crib, right? That is always the case. But 90% of the people are fine, because the fact is that when you are talking about an AIF, you are only dealing with HNIs. You're talking about people, you're dealing with people who've already made the money, right? I'm not saying they're not making more, but they have made a lot of money, right? And for them, or for most of them, the most important thing is the money that I've made, I want to first protect that. So that's the reason protection of capital becomes paramount for a lot of these people, right? So that's one of the other small nuances that, again, to me, it matters, and that's something that I have looked at in the past. And last but not the least, I think one has to be consistent with their approach. And like I said in the beginning, right? I mean, like, you may have an approach saying that I want to only go direct, I don't want to go distributor. I have a close friend who's an example of that, who's built an entire asset management franchise over the last decade, and today has more than 3,000-4,000 crores of assets in the long only space, which is fairly crowded. And the entire franchise is built on direct, right? But the point is that you have to have the patience. Saying that I am okay if I don't get assets. I'm okay to spend the next 10 years getting these assets. And I mean, like, from his perspective, he was very confident in his performance, right? So he's got a performance track record which is probably better than 99% of the street, right? It's not easy for everyone to do that. But that's fine. You can have that approach. But if you don't have the patience to do that, then it's important to understand and accept the fact that you need distribution partners to take you along to clients, right? And build that asset size for you, right? So that's the other thing which is very important. So I think I've covered most of the important aspects that I try to implement, when I am trying to raise assets, whether it's here or in the previous organizations. So I don't think I have anything else to say out here. More than happy to take any questions if there are any. Please. Yeah. I mean, like, for us, it's an and. For us, it's an and. I'm saying because this is a common debate that, most promoters, founders of firms, started funds would say that, why do I need distributors? Why can't I go direct, right? And that's the reason I'm saying it's direct versus distributors is a common thing people think about. Because what everybody wants to do is that, why should I share that 50, 60, 70% of what I make, right? And when I talk to some people, they will say that, Arey, what are they bringing to the table? They'll only introduce somebody to me. Beyond the point, after that, everything I'm doing. For that, why am I paying 50%? The other thing is that people also see what happens internationally, right? Because if you go to the international markets, even if you get a distributor there, you don't, in most cases, you don't land up sharing more than 20%, right? We've also done that in the past. But the point is that for that 20%, you are talking about a very different market. You can't compare apples and oranges. You're talking about institutions there. You're talking about a handful of names which you can find on some of these, research websites, and you can get the database, try to talk to them directly as well. It's just a finite number, like maybe a couple of hundred. That's it, right? Versus out here, I'm like, try to look up that base, you'll never find it.
Bhautik, you covered, I think, the domestic distribution space beautifully. If you could just throw some light, because I believe you've got some understanding on fundraise offshore, which is international. If you could just kind of touch upon it, point number one. Point number two, I think there's regulation as far as how do you actually calculate the difference between direct and the regular plan, or distributor plan, as far as mutuals are concerned. Do you see something happening that even in the AIF space?
Sure. So on the first part, unfortunately, I've not been successful at raising money offshore. But yes, I have some experience there. See, out there, I think, I don't think we try to do it any differently. Idea was we just picked which markets we want to go to. So I think from an India perspective, the lower hanging fruits were primarily markets in Asia. So Dubai, Singapore, Hong Kong, because, and that's a fact that some of those guys who are sitting there, they know India better than when you go and talk to an investor sitting in the US, right? So it's very, very important, because out there, the market is so vast, right? I mean, like, you can spread yourself everywhere. The other thing is that out there, the patience game is even longer, because when you're talking to institutions, the time taken from the first engagement to the time they will even decide to, do a due diligence on you is at least a year in most cases, right? So which means that, doing the cold calling, going and meeting that person, or sending that information on a continuous basis, right? Because again, if you think about it out there, when in India, let's say a wealth manager is getting, is getting bombarded from, let's say, 50 asset managers, out there, that number is at least 10, 20x of that. And from their perspective, single country allocation comes like at the lowest level in some sense, right? So again, out there, it's very important to understand, do I want to first identify the market? Within that market, do I want to go to the larger institutions first? Do I want to go to a family office? Do I want to go to a fund of funds? So differentiate basis that, slice it, dice it, and then think about it, where are you the most relevant? And what's the most lowest hanging fruit? And then go and kind of approach there. The other thing is that one has to also think about it that we can't just go to any market and start marketing. So there are passporting regulations in every market that you go to, which is, one has to be compliant about these things. And that's the reason it's very, very important that, when you open up yourself to some of these geographies, you have to first do the compliance before you step into any of these markets and start talking to clients. Yeah, and on your second part on direct versus regular, so at least at this point of time, obviously SEBI is not mandated anything, and that's the reason if you see, at least what I see in the industry is that everybody is doing their own, in terms of direct versus regular, not just direct versus regular, but regular, direct, advisory. So there are multiple structures which are floating out there. I think, I think one big difference between, let's say, an AIF versus mutual fund is that in an AIF, it's still a very, very push product, right? In a mutual fund, the information has become very, very transparent. People can, click one button and access all the information, and not only access, at another button, they can invest also, which is not possible in AIF, right? So there is a lot more that one has to, talk about, engage, and ultimately, an AIF is supposed to be a sophisticated product, which means you're talking to sophisticated clients, and it has to be done on a private placement basis. So if all those factors are there, when I go to any other international market, there is nothing called direct and regular. There are different share classes, which are for institutions, for individual investors. There is nothing called direct versus, regular in those markets, right? Yes, there'll be a different share class for institutions, there'll be a different share class for other investors. Maybe there are share classes for different size of investors, right? Because that is what works for sophisticated investors, right? And the whole logic of a sophisticated investor is that he's able to decide on, what share class makes sense for him, what's the fee structure, and able to then decide whether I want to invest or not, which may not be the case for retail investors investing in in mutual funds. So I'm hoping that, they don't kind of have a mandate out there saying that keep a differential, of XYZ% here.
So Bhautik, slightly different question.
Yeah.
So in my role of running a community, and having a bird's eye view of the industry, and really being privileged to watch professionals like you, up and close as an academician, I think you are a perfect case of someone who's grown through the ranks through sheer hard work plus smart work. I think for the benefit of your juniors and peers sitting here, watching virtually, and those who are going to watch it later on the recording, give us some career hacks, today, you at a very young age, you're doing phenomenally well. You've really grown up in the ecosystem, and I'm sure there's a lot that has gone behind the scene as well. So maybe a few quick hacks, quick tricks.
I wish there was anything from the Harry Potter world that I could bring here, but no. But thanks a lot for those nice words. But no, I think one of the things that at least I have done in my career is that I don't think there is anything which is small or big here. Like, for example, in my mutual fund days, going and selling a 100 rupees SIP in some outskirts of Bombay, which I can't even name because I don't even know what that station was called, and sitting just outside a small restaurant with a projector screen out there and talking to 5 investors, talking about 100 rupees SIP, versus let's say now meeting a family office and talking about, let's say, a much larger check. Even today, I don't have a challenge doing that, right? Because I don't think one is less important than the other, right? So I think that's something that I have never had a challenge with. And I think if we keep some of these things, out of our mind, saying that this is less important, more important, big distributor, small investor, big investor. And this is a common thing which comes to a lot of people's mind, but I think as long as we don't differentiate, in fact, I've always been a proponent that I'll be happier to get 10 smaller investors than 1 big investor. Because I've always seen it in the past that they've stuck around with us much longer than what that 1 investor would do, right? Whereas most people that I talk to, they will always prefer that 1 big investor or that 1 big check. That's what most people like to see. So I'm just saying that, A, there is nothing which is, big or small in terms of, what you're doing. And B, most important thing is keep things simple, please. It is a simple industry. It's a simple thing that you keep. Just do a simple thing on a consistent basis is the most important thing out here, which is where we try to complicate stuff because, I don't know, somehow we just think that complicating it might feel fancier, but not necessarily always works. Yeah. I am saying any approach is not a wrong approach. Whatever works for you. So whether you go with multiple distributors or you go with 1 distributor, both have their pros and cons. It's as simple as that. You have to just understand what is the pros and cons of both the approaches and ensure that you're sticking to that approach. Because what most people end up doing is that they think of this approach, don't think of all the pros and cons, go with that approach, and then somewhere along the way, in a short period of time, they will see that it's not working. Now, then they change track. So changing track, I don't think helps, right? Because that will again, put you back to the drawing board, trying to think about it, this is not working, let me now figure out another strategy. Have a strategy, understand what are the pros and cons of strategy, and just stick to it. It'll work. At least that's what I have seen in the past, right? It does work. One has to be patient for it. And see what you do around performance, consistency of performance, all of that is paramount because that is what matters and that is 70% of what matters, right? Everything else that you do is maybe 30%.
Thank you.
Any more questions?
I'm just giving the real-time example. The one mistake can kill the entire deal also. When you appointed the distributor, you have to trust on him actually. You have to go with the pace, with the process actually. So this is just one learning which I had.
No, I completely agree with you. I think, it's a good point that you brought up, and that's something, again, that I have seen along the way is that, let's say if somebody introduced a client to me or distributor, and then thinking about it that for the next fund, let me go to this client directly. I don't think shortchanging, the existing partner works, because shortchanging would basically mean breaking of trust. And the industry we are in, it's only about trust. That's the most important thing that matters out here. Everything else is secondary. Once you break trust, building that takes, in most cases, even difficult to build it back again. Yes, it's more or less lost forever.
Any further questions? All right, thank you so much. Let's give it a round of applause.
Thank you.
Now may call upon Mr. Aditya Gadge on stage to felicitate our speaker. Thank you, Mr. Bhautik Ambani. Thank you so much.